Welcome back, ladies and gentlemen, for what is going to be nothing short of another jam-packed daily cryptocurrency market update with yours truly. I hope you're all having a wonderful Wednesday, and as always, we have a lot to cover. We're going to be starting things off with the kind of macroeconomic situation. Doing a little bit of very quick recapping, obviously, in regards to Friday's non-farm payroll. We know the effect of that in regards to increasing the probabilities of a recession. There's going to be readjustment as a result of that. And then, of course, we've had a compounding effect on the markets as we see the Japanese yen carry trade start to get unwind. We'll be explaining that in a little bit more detail. And then we're going to be diving over to some GDP stats. So it's my opinion that we're not in a recession, we're not going to enter a recession, and the markets are going to do well. If you're in the bear camp, the S&P will rally within 2 months of a recession, i.e. it will start to price in a recession 2 months out. And we don't think that's here. We don't essentially think that's the situation. Actually, we think we're moving into a situation which aligns with global liquidity, PMI cycles, the Bitcoin 4-year cycle theory, a lot of things, a lot of confluence there. We think we're entering a situation where actually risk does very well, and crypto is going to be the best performer in regards to risk. We're yet to see Bitcoin dominance role. When you look at the kind of cycles and what happens around the halving, we're in very good standing. In fact, Bitcoin's been very early, and I think that has a lot to do with institutional investment. If you look at the coins that have received institutional investment, like ETH and Solana, they're the ones that have done well, whereas the rest of the altcoin market, I think, is really still yet to catch up. But its time will come, and we aren't really seeing anything out of the ordinary in regards to normal cycles. And certainly as long as, and why we cover the macro is because it's just so important. Crypto really finds itself, and we saw this on Monday, as a paper bag in the wind in regards to what's happening with larger markets. And of course, the currency markets, some of the largest, debt markets are really the largest if you don't account for all derivatives out there. So we're going to be starting the video off there, and then we're going to be talking and showing you some more proof in regards to the fact that this was likely just a shakeout. And we've got a number of things to share with you. We've got Richard Teng, who of course is now Binance's CEO, talking about some of the net dollar inflow, so not crypto inflows, that took place within the past 24 hours, which makes it the highest day, and this is referring to Tuesday, so yesterday, of actual capital going into the markets, or certainly Binance from a money point of view. And actually, they saw the highest trading volume on Binance in regards to a year to date. So we know that people are essentially buying crypto. Also, we've got news from JP Morgan. Says institutions bought the dip while retail panic sold. And we've looked at a number of metrics in regards to that. One of the metrics we looked at was from Checkmate, who I believe, did he work for Glassnode, potentially? But he posted something saying short-term holders puked out so many coins yesterday in regards to Monday. They locked in losses at a similar scale to FTX's collapse. And that's actually, like for us, for example, we were getting back into the market, certainly when Bitcoin was 16, 15K after being out for 2022. We were waiting for some sort of capitulation. We were looking for those divergences. We got it. Usually it's a good time to enter after some sort of capitulation. And we certainly know that hedge funds, and in regards to crypto inflows, there was absolutely buying that took place. So not just JP Morgan, also Goldman Sachs saying a very similar thing. We see BlackRock inflows yesterday in regards to their ETH ETF, ETH A very much just following a similar trajectory that IBIT, which was their Bitcoin spot ETF, followed, and then there was a 90% rally. I think Ethereum's is going to be significantly higher, certainly from this low point. Talk a little bit about the VIX, because the VIX went crazy, and we'll look at VIX spikes and what typically happens after that. And I think providing, and this is why we're starting on the macro, we aren't entering a recession, the markets are going to continue to do well, and we don't think you are going to enter a recession until certainly later on in 2025. So without further ado, let's dive into it all, ladies and gentlemen. Hang in there. I know the cryptocurrency space is volatile. This is why we do not push people towards trading, and certainly with any kind of a leverage. Even myself, I don't really, unless I see a more of a large pattern playing out, I don't really trade the cryptocurrency space, more invest in it. That's what I teach. I teach people to understand cycles from a kind of technical point of view. Market cycles sort of derived from Stan Weinstein's stage analysis, from Charles Dow's theory, and also the likes of Wyckoff's market cycles, not just the accumulate and distribute pattern. We are going to be rolling those courses out to the public. But To start things off, GDP now prints up. So this came out yesterday, and this is the latest estimates for GDP are 2.9%, which means that there is no recession in sight. And I think, yes, non-farm wasn't amazing. We looked at Tom Lee's comments in regards to some of the factors that went into that not amazing print, the revisions, the likes of hurricanes and things that happen in the US. We also listened to Kamal's CNBC talk yesterday, where he actually spoke about, actually, it's not that much of a bad number in regards to the number that we got. And of course, the actual unemployment level isn't like dangerous territory. It's not bad. It's not great that it's uptrending, and that's the real worry. So Friday, of course, we had non-farm payroll and unemployment. That increased the probabilities of recession. You're going to have a kind of a hedging of that probability on that number. And of course, you'll get a kind of reallocation, certainly if data improves. Inflation's not an issue, in my opinion. And you can say, okay, well, if you ignore their stats and deal with the everyman and woman in the street, potentially it is. I would also argue that, I go out to restaurants a lot. They're always full. We don't want to go down that whole rabbit hole too much. And then, of course, we've had, with the Bank of Japan upping interest rates for the first time in 30 years, if you think about the Bank of Japan, we'll come back onto GDP in just a second. Just like when the dollar had low interest rates, people borrowing dollars and putting it into the markets. When they upped it, they need to basically close that trade, that arbitrage. So the Bank of Japan, or the yen, is really kind of a creditor to the world, meaning people borrow and then they put it into things where they can get a better yield, like the US market. The Nikkei is a short yen trade, which is why the Nikkei had such a correction. There's been contagion with the markets, and you would expect the kind of volatility that we saw based on the fact they haven't done this in 30 years and the unwinding that took place. Obviously, crypto really bore the brunt of it, being the highest beta kind of asset class that there is. But if that is just the equation, and there's that readjustment taking place, and there might be further readjustment, certainly with the Fed starting to lower their interest rates, whilst the yen has a higher interest rate. So there might be a little bit more unwinding. But if that's the issue, and it's not an economy one, and the economy is going to continue to do well, again, the S&P will rally. This is a great stat. Within 2 months of a recession, it will start to price in a recession 2 months prior. So if equities, and we get this macro right, and of course dollar is very much going in the direction we wanted it, perhaps on a different context to what we wanted it to do that. When the dollar comes down, ultimately, when you look at the broad picture, it's not a bad one. So let's go back to this GDP expectation. So GDP Now model estimates for real GDP growth, seasonally adjusted annual rate in the third quarter of 2024 is 2.9% on August the 6th, up from 2.5% on August the 1st. After recent releases from the US Bureau of Labor Statistics, the US Census Bureau, the US Bureau of Economic Analysis, and the Institute of Supply Management, the nowcast of the third quarter real person consumption expenditures growth and third quarter real gross private domestic growth increased from 2.6 and 1.6 relatively to 3% and 2.8%. So you can see there's been an uptick in this. The good thing is we know that GDP numbers for Q3 2024 is likely to be positive and above potential. So better than expected. So no signs of a recession just yet. We need more data. Just like with inflation, we were some of the few people to say we're not in the 1970s camp, the resurgence of inflation. It's not the 1970s. And obviously Volcker became like a very zealous talking point throughout this entire period. Certainly Jerome Powell giving him a lot of credit, which made people think, are we entering a similar thing? But the idea of not being an idiot is you learn from the mistakes that you previously made. So the bad news is that we know this is because the accuracy of the GDP Now is predicting GDP is impossibly high, suggesting the BEA is effectively using GDP Now type models post the events of March 2020 rather than prior methods. So there is tampering with statistics. We get a lot of comments in regards to people saying, but this isn't the case because of these shadow stats or this. The shadow stats we are, of course, interested in, but not focused on, because the official stats, whether they're made up or whatever, tinkered with, is what the Fed go by and what the economy ultimately goes by. And if there's a disconnect there, there's a disconnect. It will eventually come to the forefront and hopefully be reflected in the stats. But ultimately, we go with what's official. whether it's tinkered with or not. And that might seem dumb to some, but ultimately that's what drives the Fed, their mandate, and ultimately the markets. So no sign of a recession just yet. This has ultimately been our thinking. And I mean, even yesterday I did a video where I looked at, a lot of people will comment about Warren Buffett having all the cash that he has, but in regards to the amount of cash he holds relative to his percentage of his overall portfolio, he had a similar thing back in 2020 in regards to percentage. And if you look at, Warren Buffett's held a lot of cash for a long time. Actually, the markets have gone up since 2020, end of 2022, and he still had a lot of cash. So is he the best predictor? A crash will eventually come, but I think you've got to be a little bit more sort of intricate with the markets. So the macro picture, I think, is going to continue to do well, or at least be sustained. And I think, obviously, the events of Monday had far more to do with the Japanese yen carry trade, which I think was actually healthy, the unwinding of that, than anything. And we'll see what happens with interest rates and things like that. But we are expecting the Dixie to come down. Generally, this should be good for risk, even though there's a bit of turbulence in regards to that taking place. Let's talk about the fact that we are seeing money buying the dip. And often, certainly when we look at a couple of articles here, so this is from JP Morgan, and this one is in regards to Goldman Sachs. So US single stocks saw most net buying since March on the back end of that. That's not retail, because we know from a crypto point of view, short-term holders, i.e. retail, and we know that retail largely is still not massively here in regards to the altcoin market, actually puked whilst your institutions bought. It's a great game that's being played, and that's why this channel is as important as it is, because we want to keep people on the right side of that game that is being played upon you. It's all about impoverishing the masses and enriching. I don't like to use the word the rich, because it tarnishes, everyone's perception of rich is very different. It tarnishes a very broad scope of people with a very broad brush. By rich, I mean the top 1%. If you look at the money supply, they've just got richer with that. So, Richard Teng, obviously the CEO of Binance, amid the macroeconomic climate in yesterday's market downturn, Binance recorded a net inflow of $1.2 billion in the past 24 hours. This is referring to Tuesday, of course. According to Tuesday and a little bit of Monday, so at the back end of Monday. According to DeFi Llama's SEX transparency metrics, this marks one of the highest net inflow days of 2024, indicating strong investor confidence. Yesterday also saw one of the highest trading volumes on Binance year to date. We are now witnessing a rebound in major token prices, with current market trends validating this. So this is significant. This is Binance's total assets, $100 billion. The SEC couldn't have $100 billion in someone they couldn't control's pockets, but that's for another story. It's one of the most gangster takeovers I've ever seen. I'm a big fan of CZ. Somebody I really am hopeful as the channel grows, we have the leverage to sort of interview in the future. Whether we want to talk or not, after all, this is another question. So that's the crypto side of things. The interesting thing here is when you look at short-term holders, they puked out so many coins yesterday, they locked in losses at a similar scale to when FTX collapsed. That's usually a great time to get in, when the masses are kind of depleted. We also wiped out a lot of futures, so there's like a deleveraging that took place. Longs liquidated and margin calls have completely cleared the leverage books. Very few stops and liquidations survived. Why we don't encourage anybody to trade. Invest, you'll do just fine in the crypto space. Get those macro trends right, get the broader context of the markets right, the technicals of in regards to cycles right, and you'll do well. And that's all I'm interested in teaching. I'm not interested in showing you this magic indicator or that magic indicator. I'm not interested in that. I'm interested in providing information that I genuinely believe can help everybody out. And hopefully we've been doing a decent job of that. Crypto, it's been a bit of a bee in our bonnet. Certainly your altcoins, because they're still really just in that accumulation range. We've yet to see anything, but I do think that's coming. This was rather interesting also. So this is from JP Morgan. Says institutions bought the dip while retail panic sold aggressively. We know that from crypto metrics in regards to short-term holders. We've seen from Richard Teng that there was a massive inflow. Retail sold $1 billion, a 2.5 standard deviation below the 12-month average. The price action very much validates that. Institutions bought $14 billion. Which is a 2.9 standard dev deviation above the 12-month average. I'm not. I'm a fan of that. I'm happy about that as somebody that's sort of held through this. But I'm also, it just goes to show the little guy just is largely clueless. Subscribe to the channel, guys. So hedge funds buying the dip offers a glimmer of hope for the markets. This is kind of where this came from. So the US stock market saw most net. I'm not going to log into my Bloomberg and show the full article because, of course, it's behind a paywall. So they want to charge for content. They're allowed to do that. US stock market saw most net buying since March from Goldman. Stock still costly, but you can tell yourself it's a deal. We also have news that the ETH ETF, ETH, or ETH-A, saw inflows of 108 million. ETH-A very much just following a very similar trajectory to what, and this gap's likely going to get closed in my opinion. It doesn't mean things are going to recover instantly, but certainly towards the back end of the year, it's on, guys. It really is. This just following the same trajectory that Bitcoin followed. Obviously, there's a different kind of variable in the markets right now. But if you look at IBIT, it did the exact same thing. Sold off, boom. You're going to close this. And actually, in the broad context of Bitcoin, this is good. This is what we want to say. Our good friend, Francis Hunt, if you're not following the Market Sniper and the Crypto Sniper, do so. He's taught me more technically in a few years than I've learned in a long time, put it that way. But he was highlighting you've got a sort of very similar thing to what took place here. And ultimately, sometimes the markets need to go down before they go up. And we think everything is still on schedule. Of course, there's going to be curveballs thrown our way. And this is why we roll with the punches here. And ultimately, if you look at the VIX, for example, look at this spike. It's similar to, this is the longest day really in recent history since March 2020. And look at the price action you saw on the back end of March 2020 on that VIX spike. And then when it started to come down, which I think this will, you've just seen a major unwind. And volatility, the reason you're seeing bigger spikes is because the markets are just more volatile. This was kind of on par with 2008. Is it as bad as 2008? Well, take advantage of that volatility. Volatility can be your friend. So we've covered a hell of a lot. It very much does look like retail very much puking and institutions largely buying the dip. Stick to the plan, guys. It's still in play, even though we saw a lot of volatility. When you have days like what we saw on Monday, the optimal thing for me to do is take things into account, work out exactly what's happened, is it explainable, if we can explain it, and then we can derive what happened and why it happened and what the broad ramifications were, and it doesn't throw anything off kilt. So really it had a lot to do with the yen unwinding. We could see more of that, certainly if the Fed starts lower interest rates. I personally don't think the Fed should rush to lower interest rates. I really don't. If I was Jerome, I'd maybe just stick to the course of September 25 or maybe a 50 and then just see how things go. I think the data that we're getting actually isn't as bad as people are making it out to be. The bears are exactly that, the bears. Everyone's entitled to their own opinion, albeit if it's a wrong one. That, of course, is I'm really prodding at the bear here. But no, hang in there, guys. We know that institutions and more sort of informed money bought this dip. They saw it as an opportunity, whether you're getting that in regards to Goldman reporting it, JP Morgan, whether you're looking at inflows from Binance, whether you're looking at the retail puke that took place, whether you're looking at ETF inflows. It's a picture that's been painted, and providing the reason why the markets did what they did was to do with the yen unwinding. We're in good standing. That's it from me, ladies and gentlemen. Look forward to seeing you all in the next one. Don't forget to hit that subscribe button. A like and a comment is already appreciated. And check out the Patreon if you're interested. That's it from me. See you in the next.